Good evening, ladies and gentlemen. Welcome to Somany Ceramics Limited's Q3 FY’25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the management's opening remarks. Should you need assistance during the call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Naveen Agarwal, Head Institutional Equities at SKP Securities Limited. Thank you, and over to you, sir.
Good evening, ladies and gentlemen. It's my pleasure to welcome you on behalf of Somany Ceramics Limited and SKP Securities to this financial results conference call. We have with us Mr. Abhishek Somany, MD and CEO, Mr. Srivatsa Somany, Mr. Shailesh Raj Kedawat, CFO, and Mr. Kumar Sunil, Head Strategy and IR. We'll have the opening remarks from Mr. Somany followed by the Q&A session. Thank you, and over to you, Mr. Somany.
Thank you. Welcome, ladies and gentlemen, to the earnings call of Q3 FY'25. As you must have seen the results by now. Again, this quarter was weaker domestic demand, and it continued with the lower exports overall for the industry, not for our company, but a weaker domestic demand. However, within this domestic demand, which for the industry was negative, and the export was also negative, I'll come to those figures. Our sales grew by 4.5% in Q3, which is better than what we did in Q1 and Q2. Operating margins were maintained at 8.4%, which is similar to the last quarter. Gross margins improved by 1.4% in Q3. Capacity utilization went up from 77% to a little above 80%. Gas price moved up by about 4% in Q3, purely on the account of a little bit on the movement on the dollar, plus a little bit on the natural gas prices on the spot. As you can see, the margins, as I mentioned, have been maintained at 8.5%. Of course, it's down from the last quarter, sequential Y-on-Y, and from 9.7%. But from the previous quarter, we've been able to maintain it. As a result, PBT and PAT are also down. I will take you through the segment reporting, which is our ceramic tiles. We have done in Q3 34% constituted of ceramic tiles of sales. 28% was PVT, that's polished vitrified tiles, and glazed vitrified tiles, which is the sunrise segment, is 38%. Exactly as per our commentary. Last year it was 34% in Q3, and we said we will take it up to 40%. So we are at about 38%, and this is continuing to grow, and it will cross 40% very soon. Bathware sales grew. We were very happy with the bathware sales, considering all other manufacturers are either flat or negative, is what we hear. So bathware sales are at about 8.5% in Q3. Capacity utilization in the bathware segment was better than the tiles. It was at 87% for sanitary ware and optimum capacity for faucets. Brand spends were maintained at 2.5% of sales. Working capital was largely maintained. We had a little bit build up in the inventory, so whatever you see a little bit extra is on the inventory side, whereas the balance sheet has been under check, and we have not bought any sales. Therefore, our receivables have only gone up by a day or two, which is in line, much better than the industry, but in line with our expectations. Our distribution network increased. We added 134 net dealers and 46 showrooms in the 9 months, which is up to Q3. The guidance again is the mid to high single digits. We do believe that Q4 should be slightly better. Like Q3, we've seen some green shoots. EBITDA margin, we will be improving or maintaining for sure, but improving a little bit depending on how much we are able to sell. Brand spend will be maintained at 2.5%. The total debt, inclusive of JV, has been brought down. It now stands at 299 crores, inclusive of all working capital and term loans. Out of this, 78% of the 299 crores is in two entities, which are our newest JVs. Sudha Somany, which is in the South JV, which is 115 crores, and 107 crores is in the brand new plant, which started only almost just about a year ago, which is the Max, Somany Max. Out of this, the term loan is 158 crores, and the current maturities are 41 crores, and the working capital is 101. So we're very, very comfortable as far as our debt is concerned. Asset turnover to Concall level is 2.3x. The Max plant, I must say, is getting stabilized. We are now at 51% capacity utilization, and we're doing another launch soon in the month of March or early April, which should take up the capacity even further. But we're very happy. Again, here we are playing the patience game and not discounting the product. We're holding on to prices. And that's how you can see that our average realization has not come off, whereas we've seen in the industry pressures on that. We've been able to maintain this by A, not discounting much, and also by selling the more value added at a fair value. We do have an exceptional gain of 9.42 crores with the disinvestment of the two JVs and a capital release of 20 crores, which can be utilized for new strategic investments. I would like to bring to your notice that we've got out of the two JVs. This is in line with our statement earlier that we would be using our capital employed in a much better way. One of these JVs was not a very profitable one, and that was the reason is because ceramic wall tiles are losing sheen and it is selling less than what it was, what the capacity of this plant was. Plus also ceramic wall tiles, because it's become so competitive, we have found better vendors in regional areas. So we found a vendor in the north and we found a vendor in the south. So it was only prudent to get out of this JV so that we can source better, smarter, cheaper from regional sources and get some profit in the bottom line. So the P&L will look better by disinvesting from this JV. Although this JV will continue to be our supplier, but by releasing him from a joint venture agreement with us, he now can sell to other people, we being the largest buyer any which ways. But then in that case, the minute he starts using a larger amount of his capacity, we will be able to also buy from it at slightly better and cheaper prices. The Acer JV was again another exit. This exit was prompted by, again, the same reasons of this particular product losing sheen, which is the normal glazed vitrified tiles. And also this JV had come of age. We needed some investments here to renovate this plant in terms of the polishing line, etc. And the third reason also was that they exited. One of the partners sold some stake to Millennium, to Inframart. The Millennium Group partners of Acer sold to Inframart, and that also was on discomfort to us. So therefore, we exited this JV. Again, this would be value crediting as far as the P&L of Somany is concerned. Largely, I think it's been a fairly decent quarter. Like you can see, we have not bought any sales. Our balance sheet is on the check. Our free cash flows are only getting better after the buyback, which we did, is getting better slowly. And the first 2 quarters were very muted. So since then, it's only becoming better and better. We are looking at some other strategic investments, one of which has been announced in the board meeting this quarter, whereas we're buying a construction chemical business. So I have been talking about it, and this was a very, very small acquisition, and we're looking at this to build up our construction chemical business in various other categories other than the adhesive and the grouting business, which we already have. So this would be something we're very excited of. It's early times. Let's see how we can shape up this company. Very fortunately that this company which we're acquiring is in Bahadurgarh, which is literally a 10-minute drive from our existing facility, tile facility. So that makes it easier for us to manage this entity. And it comes with a sizable piece of land and building. And a lot of intellectual property in terms of various different formulations. So now it's a question of strategizing with the partner and seeing how we can ramp this products up in the B2B and the B2B segment. Of course, very clearly we have a right. We will be moving up to 100% ownership of this plant in the next 3 to 5 years. So that's already agreed upon as a creeping acquisition over the next 3 to 5 years. We have 51% currently, and then we will keep moving up from 51 to 100% in the next 3 to 5 years. So very excited about this new JV, which is the new acquisition, which is in line with our products. It goes to the same B2B supplier, so it's all to do with building, whether it's commercial or whether it is residential. And also, some of the products which this company makes is in line with our existing dealerships. So some of it will flow into the same dealerships, and some of it we will be contracting some other dealership, which again is very exciting times to form new alignments with trade partners. So very excited about this business. Having said that, tile remains to be our focus, sanitary ware the next focus, and construction chemicals will be the new foray. But we are doing this because it's a growing business, and also the network is kind of common. So that gives us a lot of comfort, just like when we started adhesives. So this is it, and I would now open the floor to the Q&A. Thank you so much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from Sneha Talreja from Nuvama. Please go ahead.
Hi. Thanks a lot for the opportunity.
Sneha, we cannot hear you well. You're cutting off, please.
Is it better now?
Yes.
Yeah. Just wanted to understand demand perspective from your end. Is it higher quantity and slower?
Sorry, Sneha, you're cutting off. Not been able to hear you.
Sir, is it better off?
Yeah.
Yeah. Just wanted to understand the demand perspective from your end. We have seen, I don't know which H2, but we always hope that, demand would revive in H2. But somehow we have not been seeing that. And with the amount of completions that we would be seeing on ground, I just wanted to just understand where are we missing this demand in terms of?
I don't think we're missing the demand, Sneha, first of all. I think we've grown better than the industry. And the Morbi industry is only in negative growth. Some of them are shut permanently. Some of them are shut for this whole month of January. So I don't think we're missing demand or we are losing market share. In most areas, we are only gaining or maintaining our market share. And I think that question, which is where the demand is gone, considering so many buildings have come up, we are also looking at when these buildings will start getting into completion and eagerly waiting for it. But to give you some kind of a sneak peek into it, the kind of orders we have secured with the residential builders and some commercial builders in the month of December and also in January, they're very, 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 very positive. And some of them have started supplies from the month of February, March, but most of the supplies will happen in the first and second quarter onwards. So there are green shoots there, but it is kind of perplexing as to why the IHB, which is the individual home buying, is being delayed and deferred, because homes are being made, will have to get made. Tiles are the preferred material, sanitary ware, there is no choice but to put a bath fitting in a sanitary ware. So it is a little perplexing. I think this is a deferred purchase, and there is overall slowdown in the economy. Having said that, I think looking at other people's results in the building material stage, I don't think we are worse off than them. We are only better off. And we've been able to maintain margins, and most importantly, we've been able to maintain our receivables, which means clearly that we haven't bought sales, or we have not sold very cheap quality materials or a cheap quality new brand or anything like that.
No, very well understood on the balance sheet part. I appreciate that effort. On the margins front, given that, you also mentioned that, you have secured certain orders on the project front. will it incrementally lead to any further margin dilution for us, given that, we've heard leaders speaking on, incremental projects order coming in, which has led to certain margin dilution?
Not really. I don't think it is at a certain margin dilution because we've been able to maintain. I think we have slightly lower base. We have a little bit of a cushion. We have a slightly lower base on the upper end spectrum of the tiles, which is the large format tiles, etc., where some other manufacturers are selling more than us, especially industry leaders. So I think we have a little bit of cushion there. We are pressing the pedal there to increase that sales, and I think it should be able to compensate. And that's what's happening right now also. So yes, it's a question of what we are selling to these builders. We are not really selling the wall tiles and the standard floor tiles. We are selling GVT tiles, but here it's a question of selling at slightly cheaper prices. But if that drives my capacity utilization up, then it kind of compensates for a slightly lower margin on that particular project, because my capacity utilization gives me a lot more leverage in terms of economies of scales, and also more importantly, the quality of the tiles. That also improves when I increase and run the plants at full capacity. It gives me cost leverages.
Understood. So that was helpful. And last question, if I may ask, what would be a current mix of retail versus projects? And also, if at all, you could give some sense on tier 1, tier 2, tier 3 sales for us.
Sneha, that particular mix has remained largely the same, which is 10-11% up to 12% is government, and I think the private sales is still at that 7-8%, but the kind of orders which we picked up will increase by 2-3%. 2 to 3% is export. So we were always in the 77 to 80% range as far as retail is concerned. I see that coming down to 74-75%, wherein the 2-3% will get converted to the residential and the commercial private builder sale. That's what I see in the next couple of quarters. Clearly, we are taking more orders from builders, but please be rest assured that these orders are not coming at the cost of any receivables. It may come at the cost of slightly lower pricing, but then that I just mentioned, it gets compensated by my capacity utilization.
Understood, sir. That was helpful. Thanks a lot and all the best.
Thank you, Sneha.
Thank you. Before we take the next question, a request to participants to please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from Somany from BOB Capital Markets. Please go ahead.
Yeah. Hi, good evening, sir. Sir, my first question is regarding our tile sales volume in December quarter. So if we see our own and JV tile production grew by roughly 5% on a YOY basis, but our own and JV tile sales volume de-grew by 7% in December quarter. And at the same time, our outsourced tile sales volume grew sharply by 35%. So can you please explain the reason for the same?
Sunil, do you want to take that question, please?
Yeah, sure. So, there is no significant change as far as this mix is concerned. It's by and large in line with the sequential quarter-on-quarter basis. So it is a more like a broader change in the sourcing mix which we have been doing of late. But otherwise, if you see Q2 and Q3, it's largely in line, wherein our own plant is giving us around 28 to 29% of revenue, and close to 40% is coming from JV, which definitely will change in next quarter for sure, because 2 JVs we are moving out. So that number will shift from one block to another block, from JV to other OEM. So for that matter, you will find next quarter OEM will be moving up. But this quarter OEM will remain around that number, 33-34%. So there is a movement of not more than 1 or 2% here and there.
So sorry, my question is regarding we are seeing a degrowth in our own tiles manufacturing volume, sales volume, but we are seeing a sharp growth in our outsourced tiles volume. So just wanted to know what is the rationale for that?
So that is attributable.
There's no rationale for it. I think this will correct. It's all momentary. Depends on what particular product we were making in what particular line. But the minute the demand picks up, obviously our own manufacturing will be moving close to 86-87% capacity utilization, and the JV is also at the same rate. So this is nothing to highlight. It's an aberration on a quarter of maybe a line being shut for some reason in the own capacity, which then seems as a lower capacity utilization, or maybe a particular line which had piled up stock of a particular category of product, and for that reason that got stopped. But this is an aberration. There's nothing by design. By design, very clearly, our manufacturing gives us the best margins, and after that it's the JVs and then the outsourcing. So the focus will remain to line balance and make sure that our manufacturing is at optimum capacity.
Okay. And sir, my next question is on the fuel cost. So if you can just help us, what would be the average fuel cost by region wise for December quarter and what it would be at present? And do you see any impact of sharp rupee depreciation on fuel costs going forward?
So first of all, the second question first. The decrease in the devaluation of the rupee, the component which is of the foreign exchange in the gas pricing, to that extent it will improve. It will move up by 1% or 2%, because on a weighted average, everything is not on the dollar component. Only a part of the gas pricing is on the dollar component. So that will obviously increase with the rupee going from an average of 85 to now closer to 88. But having said that, in quarter 3, our pricing overall was 45. Last year same quarter was 44, and last full year was 44. So no major change. Our northern plant, the pricing was 43. Our western plants, all our western plants, including the Morbi joint ventures, were at 49, and the southern plant was at 51. So no real change as far as the pricing is concerned. And this I am quoting figures only for the natural gas pricing, not for our biomass and our coal.
And so lastly, I just need few data points. If you can just give us a sense, what would be the capacity utilization of our Somany Max plant in December quarter? And what is the reason for...
51, Utkarsh, I had mentioned it earlier, 51%.
Okay. And what is the reason for increase in depreciation cost on a quarter-on-quarter basis?
Okay. Sailesh, you want to take that question?
Yeah. So there is some accelerated depreciation we have taken on some of our equipment which we have discontinued. So we are doing the line balancing in our Qatar unit, and there are some old equipment which we have removed, and we are putting up new equipment. So there's a one-off charge which has come in this number.
Okay, so the normal run rate would be 19 crore only going forward?
No, normal run rate will not be 19 crore. It will come down because this is a incremental charge which has come in this quarter. There is some more incremental charge which will come in quarter 4 because we are still doing some line balancing. So there are some equipment which will come out, and there are some new equipment which are getting put. But the normal run rate will be around 16 CR is what I...
No, the normal one would be around 19 or 20. So this quarter it has gone up by 3-4 crore rupees.
Yeah.
So there are I would say normalized amount of depreciation would be around 19-20.
20.
Yeah, 20 you can take.
Okay, thanks a lot.
Thank you. Next question is from Keshav Lahoti from HDFC Securities. Please go ahead.
Thank you for the opportunity. I just wanted to get a sense, as you highlighted, domestic demand has degrown in market. So why is that only, tiles sector that is degrowing, while the same trend we can't see, be it pipes, be it, ply segment, be it cement sector. So what is missing in the tile sector, or something like laminate or something gaining market share from tiles? How should we read it?
No, nothing is gaining market share from tiles. How you read this is that if you see the branded segment, none of the branded segment has degrown. Most of the branded segment have either grown or remained flat. It's the entire Morbi sector which has degrown, because a large part of the Morbi sector was exporting, and with exports going from last year 20,000 crores or 2,000, last year's 20,000 crores, this year would be anywhere between 13 and 14,000 crores. So that has led to added pressure with the Morbi manufacturers, and with the stocks piling up, they've had to shut a lot of their sales. So therefore, there's been a reduction in their revenue and in their production. So and also, if the building, the real estate sector was the earlier question with Sneha, there's so much action with the building, and why is it not translating to tiles? I think that is also a question where a lot of these Morbi guys who don't have a very strong retail outlet, they're mostly selling to the builders, and the builders are not really buying at the same capacity that they should be buying, considering that there's been so many launches. So, but please be rest assured that tile is the most preferred material as far as wall and floor coverings are concerned. Obviously, we don't compete with paint, which has a very high replacement market. Neither do we compete with laminate and ply, because the areas of application are completely different when you talk of tiles. So tiles, the biggest competition, or rather another variant which one can put would be on the flooring, would be some kind of natural stone and a very, very, very niche segment of wood. Otherwise, tiles remain to be the most preferred item.
Okay. One last question from my side. Why you have the right to win over builder? Because normally, you also getting outsourcing business. So if someone is builder might be, very, price sensitive that way. That way, wouldn't Morbi have a right to win over you in builder like?
That's why builders, if you see Morbi's domestic sale, a good 70% is builder. If you see our domestic sales, 70+% is retail. So that's the answer. So a lot of the smaller builders are extremely price sensitive, and they clearly look at Morbi as their preferred vendor and not larger companies.
But now, as you are being the leader are indicating, you are going at a faster pace on the builder side. So what has changed? Why are builders now preferring you over Morbi? Why you are gaining market share on that side?
No. So I think the larger builders, the better builders across the country were never with Morbi. They were always with the branded players. But those are the builders who are on the long lead, where they finish the buildings and the finishing stage has not happened. So the DLF, the Lodas, the Prestiges of the world are mostly doing with the top 10 brand players.
Understood. Got it. That is helpful. Thank you.
Thank you. Next question is from Ashutosh Khetan from Asian Market Securities. Please go ahead.
Yeah. Hi, sir. I just wanted to ask, what is the total CapEx outflow for FY'25 and FY'26?
Could you repeat that question, please? I missed you.
Yeah, I wanted to ask that what will be the total CapEx outflow for FY'25 and FY'26?
Other than balancing equipment for FY'25, which is a new 10 crore rupee acquisition which we're doing, other than the normal balancing equipment. And FY'26, as far as currently is concerned, we have no such plan for any major capex. But I do believe that the way my sanitary ware and bath fitting is going, we may need a small capex there to enhance capacity, because I think we will run out of capacity in the next 12 to 15 months. If Shivas, you want to add something there as far as sanitary ware capacity is concerned, as to when you think we will run out and maybe need a small expansion?
I think, yeah, I think the sanitary ware, both we'll need a little bit of expansion in fittings and sanitary ware, because fittings are already hitting around 5.5 crores of production every month consistently for the last 2 months. So we're running almost 110% capacity. So small expansions that we'll be doing in machine shops and furnaces, etc., and on the fitting.
By when you would require it in the next 12 months?
I would require it in the next.
So we would require it in the post 12 months, these little bit of in sanitary ware and bath fittings. Until then, there is no major expansion.
Sanitary ware, a major one over the next 12 to 18 months, and definitely this fittings, we're already in the process of doing the smaller expansion.
When we have a figure of what the amount is for the expansion, it's not going to be an arm and leg, we will let you know. But that we would be announcing or looking at that post third quarter next year.
Got it, sir. Thank you so much.
Thank you. Next question is from Jyoti Gupta from Nirmal Bang. Please go ahead.
Good evening, sir. Just want to know any specific reason the employee cost has gone up, but by 12%, 13% employee cost in this quarter?
No, it's all to do with sales. I mean, we have got some new people in for new strategic initiatives, such as this particular acquisition which we're doing. But other than that, it is all this will go down the minute the sales picks up. So sales has remained flat and some new people have come in, increments have happened. So it's absolutely in line if we had the desired capacity utilization.
So what's the kind of sales, volume outlook are you actually projecting for FY'25 and '26?
FY'25, '26, we're looking at high single digits and low double digits. But we said that even last year that we will be doing low double digits to mid double digits, and we've now revised it to because of the muted quarter one, quarter two. But we are hopeful with what I mentioned in the first question, where the builders which have announced their buildings and that's going to come into finishing, plus some green shoots as far as economy reviving, the new initiatives from the government towards low-income housing, and also the initiatives by the government to increase spending on infrastructure. They already had that desire but didn't do it for some reason this year. So all of that should spur up the economy a little bit. With that, I'm very hopeful that this would be a very high single digit or a low double digit going forward into FY'25, '26.
So one more question in terms of freight, ocean freights. Have they started declining, and is the movement on the sea improving gradually?
Yes, some countries there's been a decline, but we don't export so much. For me, I'm sorry to have that figure at the tip of my tongue, so it would be wrong for me to comment. I would have to get back to you, but please feel free to write to Sunit or Sailesh, and they can give you the figures exactly as to how much it has gone down. I'm sorry, I don't have it on my fingertips.
No worries. Thank you so much. That will be all.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. Next question is from Amit Purohit from Elara. Please go ahead.
Hi, sir. Thank you for the opportunity. So just on a split between project and retail, what would that be? And second, is that in the event where somehow the retail growth rates may not pick up so well, would you look to have this kind of margins, or 8 to 9% margin or a 10% margin? How do you think about from a medium-term perspective the outlook on margins?
Yes, I think this was already answered as the previous question in the call was similar, but I'll repeat it, not to worry. What I'm saying is that, yes, there is a little bit of a muted demand in the IHB, which is the individual home building, which is where the retail sells. My retail secondary sale is to individual homes, you and me, building a home. But the project sale is definitely increasing, and that is not at the same pricing as the retail sale. But having said that, we have so much capacity which is underutilized, and there is no cost leverage over there. So we get a lot of cost benefits when we use extra capacity and optimum capacity, not only in terms of efficiencies of the working, but also in terms of quality. So whatever little the discounting will happen in the project segment, that will be compensated by my extra capacity utilization. So yes, with the capacity utilization going up and my value added mix only improving, you can very clearly see it improving. That's why our margins have remained the same. I'm very, very hopeful of the figures you just spoke.
Okay. No, I just wanted to know what would be the mix of project in our sales, sir.
Oh, I'm sorry. Project currently is about 10-11% is government, and about 8 to 9% is the private projects, and 3% is our export, and the balance is retail. This will move in favor of the private builders by 2 to 3%, which means the export remains the same. Government will remain more or less the same. As per the builders going up, which will bring the retail down from 79 to closer to 75%.
And for this quarter also, the retail sales would have been flattish, or you would say that it would have still grown in terms of volumes?
Retail sale has grown in terms of volumes.
Okay. Thank you.
Because builders haven't grown, and export is not grown. So whatever is grown has come from retail only.
Okay. I thought the project business has done well, right? Or you were saying that now in this quarter
it will start. Yeah, it will start moving from next year onwards. In fact, quarter one, quarter two, we've picked up good orders, but those are all sample flats which have gone, small little supplies which have happened, but the bulk of the supplies or month-on-month supplies haven't really happened.
Sure. Thank you, sir.
Thank you. Next question is from Madhur Rathi from Counter Cyclical Investments. Please go ahead.
Sir, thank you for the opportunity. Sir, I wanted to understand.
Madhur, could I request you to be a little louder, please?
Sir, am I audible right now?
Yes.
Yeah. Sir, I wanted to understand what level of capacity utilization would it take for our plants to get to that 10 to 12% kind of EBITDA margin?
So it's not only the plant utilization. Of course, I'll answer your question. The optimum plant utilization for any tile company is near 90%. Anywhere from 88 to 92% is the optimum capacity utilization. That does aid, but one thing is currently we've not been able to use the capacity for any kind of tile, the cheaper format, all the better ones. So one is to first ramp up capacity in whatever we can sell, and then it would be how we can ramp up that capacity and make it more value added. So both those really play on market margin accreditation. But to make it simple, if I move at steady state, today's pricing and today's retail versus projected sales, which is project moving up by 2% and retail going down, we still be able to add about 1.5% in margins. And after that, it would be a question of how much extra margin we can get from value-added sales combined with our efforts onto reduction of other costs.
Okay, so like right now we are 80%, above 80%. So if in the next year, if volumes grow as expected, like high single digit to low double digit, we could achieve a 1.5% in margin improvement.
Of course.
Okay. Answer on the Somany Max plant.
And I would also reiterate here, that while this is happening, mind you, there will be certain advantages which are going to flow in because of the two JVs which were loss-making, which have gone off the balance sheet. That also will add a little bit to the margin.
Sir, can you quantify what would be that improvement on a margin?
I can give that to you offline, please. Hello?
Yes, sir.
Yeah, I don't have it at the fingertips. I would give it to you offline.
Okay, that will work. So just a final question on the Somany Max plant. Sir, I think, is it at a break-even level right now, or do we still think that in a quarter it will go to the break-even level?
I'll require at least 2 more quarters to get to break-even. Anyway, first quarter next year would be good. So from second quarter next year, it should be at a profitable level, not break-even. It should be at a profit level.
Okay. And sir, at optimum capacity utilization for that Somany Max plant, sir, what could be the incremental revenue addition as well as margin can we expect from that plant?
Smith, please correct me if I'm wrong. I think that particular plant can give me 250 odd crore rupees of revenue.
Yeah. Towards the north of 250, depending on the optimum capacity utilization and the product mix for which it would be manufactured.
Yeah. So currently we're half of that.
Okay, got it. And sir, margin potential?
That would be a blended margin. Yeah, I mean, there's no separate calculation for that margin. It's a blended margin which will reflect in the blend in our consolidated results.
But it would be margin accretive to our overall.
Yes, of course. Obviously, it's a value-added tile.
Okay, got it. So thank you so much and all the best.
Thank you so much.
Thank you very much. That was the last question in queue. I would now like to hand the conference back to Mr. Somany for closing comments.
Thank you so much. Looking forward to a better Q4 and looking forward to more initiatives from the government to spur up demand. The economy clearly is lagging and we need some government spending and to spur up the normal demand. They have done, it's been a good budget from looking at the increasing the disposable income at the lowest level of tax bracket. So hopefully things should be looking up. And anyway, from our point of view, the buildings which are unfinished and yet are getting into finishing stages would give us a better outlook. And with the way the war is looking, both the wars looking to come to some kind of a conclusion, that also will benefit the freight rates and increase the sales of export from Morbi, which means that there will be lesser pressure in the domestic industry. So looking forward to all the positives. We are very excited for the new acquisition, and also we're very excited for our bathware manufacturing and Max. Other than that, we be rest assured that we have our eye on the ball on the balance sheet and will not let that slip, come what may. Thank you so much, and we shall be together again for the earnings call of the FY 24-25. Thank you so much.
Thank you very much. On behalf of SKP Securities Limited, that concludes the conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.